Hi students, good evening again. Today we are discussing about the share capital, and when we talk about the share capital, it means it is related to the limited liability company. Now the limited liability company means what? As we know, we have three types of the businesses. First one is the sole proprietorship, means the single owner. He or she is the owner and managing all the business, investing all the money, profit and loss, all is divided to that person, or it is responsibility is all on that person, so that person is a responsible, so there is no division of the profit. The second option, we have the partnership, when there are two or more people, they get together and then they start the business, their investment is there and they share the profit according to the agreed ratio, or if there is no agreed ratio, equally, and they also share the losses. But in both the sole proprietorship and in the partnership, we have a unlimited liability. Unlimited liability means what? That if the business has a loss and the loss is more than the investment, then who has to pay? The owner has to pay. Means he or she cannot say that I have invested 10,000 and now loss is more, so I will not pay. For example, if the bank loan is there and even after selling all the assets of the business, they are unable to pay, so who will pay the remaining amount? The owner will pay. The same thing happen in the partnership. So that's why there's a next level of the business or the type of the business ownership, that is called as the limited liability company, where every investor has a share capital and he or she is responsible only for that amount of the capital which he or she has invested, not more than that. If the company has a loss, and even after selling all the assets and paying the liabilities, but still there is some liability available or still pending liability is there, so owner will not pay anything extra more than the investment. So this is the basic benefit of the limited liability company. So we have a concept of the share capital. Share capital is what? Share capital simply means the total capital is divided into small shares. Small shares means what? That can be for the $1, it can be for $2, it can be for $10, even less than $1. So the total capital, so that is divided into the small portions or the small chunks. So that is called as what? As the shares. So shares is a small part of the total capital. So the first thing that we have is the concept of the authorized share capital. Whenever business is registered, obviously there's some Securities and Exchange Commission, so they have to go there, they have to register the business, the owners, or what we say, the people who are starting that business. So those are the people who are starting the business, so they will apply to the government or to any other organization like SECP for that, or there may be a Securities Exchange Commission or registrar of the company. So depending on the rules of the country, so they apply to register a company, to register a limited liability company. So government will allow them that how much shares they can issue and what will be the par value per share. We just take a simple example that they have applied for 100,000 shares and the par value is $10 per share. Means one share value, it is also called as the face value. Whatsoever will be written on the share, that will be how much? That will be $10 per share. And how many shares they are allowed to issue? That is 100,000. So this is simply the authorized share capital is the maximum number of shares that the company can issue to the shareholders. So it can be issued in the start or it can be issued later, but the maximum number of shares they can issue is the authorized share capital. So this is what? This is the maximum. Means the company cannot issue more than 100,000 shares and one share value will be $10. That is called as the par value. Or so they have a one share of how much? $10. That is called as the par value, or also called as the face value. Par value or face value means what? That on every share certificate the value will be written that one share is of it will be $10 in this company. So that is the concept, that they can issue 100,000 total shares, and one share has a par value or face value of how much? $10. It means that share capital of this company will be $1 million. So 1 million is the authorized share capital of the business. So this is the maximum share capital the company can issue. So how company issues the shares? We have a IPO. IPO is what? That is the initial public offer. Initial public offer means that some of the owners who are starting that business, who are starting that company, they may decide that we have a 5%, 10%, 20% shares, and the remaining shares we will issue to the public. So what they will give? They give the initial public offer. They say that we want to issue the share, and the share value will be how much? That will be $10, and you have this specific date. Until that date you can apply for the shares, maybe 10 shares, 15 shares, 100 shares. So they decided that how many shares each person can apply. So it is just like an application. So they are asking the general public that if they want to purchase the shares, they have to apply, and obviously if they are applying, they have to pay the money. For example, a person A, let's say Mr. X is there, they want to buy 100 shares at the rate of $10. It means Mr. X has to pay $1,000 with application. So they have to apply to the company that we want to issue the shares, we want to receive the shares, we want to buy the shares. So the company will issue them the shares if there is all the conditions met. So this is the requirement, that how many shares will be issued to each person. So they will give the offer to the general public, public will apply, they will give the applications for the purchase of the shares. We just assume that Mr. X has given application that he wants to buy 100 shares, and obviously the par value is $10. So mean Mr. X has to pay $1,000 with the application. So in the same way, so many other people will apply for the shares. They have two more things, that is the concept of the paid up capital, and then we have a issued share capital. Paid up means for each share they have to pay. Who has to pay? The public, who will be considered later on if the shares are issued to them, the certificates are issued to them, so they will be considered as the shareholders. So the paid up capital means the company has received how much money from the shareholders. So that will be the paid up share capital. For example, company has received, so share will be how much? 70,000. So public has applied for 70,000 shares, means the company's paid up capital will be how much? That will be 700,000. So this is the total number of people who have applied to purchase the shares. So the total value will be 700,000. So this is what, this is the paid up capital, means this is the amount which the public or who will be the shareholders in the future have paid to the company. So why they pay to the company? Because they have an agreement that they will buy the shares of the company. So to buy the share, they have paid the money to the company. So this is called as what? As the paid up share capital. Now when the company will receive the money, what they will do? They will issue the certificates to the shareholders. So in this case, for example, all the people, like 70,000 shares, they have received the money, and we just assume that they are scrutinized it and they have checked the particulars and all the things, all the requirements are okay, and they issue the same number of shares to those persons. So in this case, the 700,000 means the total shares will be how much? That is 70,000 shares. So these are issued to the owners, issued to the public, who are now become the owners or the shareholders of the company. So this will be considered normally in most of the cases the issued and the paid up capital of the company in most of the cases is same. There are some instances that there are differences in the issued capital and the paid up capital, because in some countries it is allowed that instead of the, for example, if the par value is 10, you can pay like $8 or $7 and later on you can pay. So we have a possibility that the paid up capital and issued capital is not same, but in most of the instances we have a issued capital and the paid up capital is normally the same. But there is some possibility of the share premium, because this company has more people who are applying for the share. So the company can say that we will not sell a share for $10, we will sell the share for $12. Now the $12 means there is a $2 extra they are receiving, because the current people who are starting this company have a very good reputation in the market, and they can ask that okay, we will not issue a share for the $10. Obviously the par value, the face value is $10, but we will issue a share for how much? For $12. So $2 what they are receiving as an extra amount, so that will be considered as what? As the share premium. Again, who is receiving the money? The business is receiving the money, but the owners or the shareholders are receiving the certificates, and on the certificate the value for the share, the par value per share will be written $10. It will not be written $12, but the money what they will receive will be the $12 per share. So in that case the amount will be different, because the extra amount, the $2 per share. So if we have a like a 70,000 shares, so in this case we can say like a 70,000 multiplied by 2, so it will be almost $140,000 as what? As the share premium. So if the company is issuing the share at $12, so in that case 10 is the par value, 2 is the share premium, and the total value of the share premium is how much? Because they have issued 70,000 shares, so in that case the total value for the share premium is 140,000. In that case, this is what? The authorized share capital of 100,000 with a value of $1 million. Paid up and the issued capital is 700,000, but the company may be issuing the shares above the par value, so extra may be the share premium. And in some cases, in some of the countries, the discount is also allowed. Means the person will pay like a $7 or $8 or $9, but the certificate the person will receive will be for $10. So the discount is also possible. But in some of the country, the shares issued on discount is not possible. So we will discuss these things later on in the next lectures. But here, as a brief understanding, we have a concept that the company has a share capital. So what is the share capital? The overall company has an investment allowed by the government, so that is called as the authorized share capital. According to that, the maximum 100,000 we considered, and from that they may issue 70, 20, 40, 60, depending on the business requirement in the start. They issue the shares and they receive the money from the shareholders. So, and the par value will be there. If the shares are issued above the par value, so that will be considered as what? As the share premium. And any person who is buying those shares will be considered as the shareholders or the owner of the company, or simply the investor of the company. So that will increasing the overall capital of the company. So there may be 100 people, 200, 500,000 people who are buying these shares. So all will be considered as the shareholders or owners of the company. Some may have a less shares, some may have a more shares, but all will be considered as the owners. And if there is an owner, the person has a right to vote in the annual general meeting or in the meetings. What does mean the voting? Obviously, who will manage these companies? The board of directors. And from where the board of directors will come? They will come from the shareholders. Maybe Mr. X is the shareholder and he can also be a member of the company board, or he may be a member of the board of directors. So in that case, all these shareholders, maybe a person has a 10 share, 100 share or million share depending on the investment, so he or she may become a board of director member with the voting. So this is the concept that how companies are formed. This capital we have issued and the paid up capital, and then the par value we have discussed, and the share premium we have discussed. All these things will be considered as the basic in the limited liability company, and later on company can also issue the shares depending on the requirement. So those will be issued maybe at par, below par or above par, maybe with the premium or with the discount, and then those will be issued to the current shareholders or to the new shareholders. All these will be discussed in the next lectures. I hope you have understood the basic concept of the share capital in the companies, but still if you have any doubt, if you have any question, you can ask me in the comment section. Thank you very much.